Hey guys, Mark here. In this video, I'm going to show you how I mapped the Fibonacci retracements last week in the euro dollar that delivered over 150 points. Let's jump right into the video. I'm going to show you how I mapped the high and the low. I'm going to show you where the key Fibonacci's came in and then how the market reacted to these levels. Okay, so here's the chart. We're going to look at basically the euro starting from September 17th, the day of the FOMC. We're going to be using the new high that we made right after the FOMC announcement at 119.19. And what we need to do is we need to look back and see what are we going to use for the start of this move. And even though the euro has been in a trend from the beginning of the year or a move up, we're going to look at basically this 113.90 level as the starting point for this leg of the move up in the euro, because you have to pick somewhere to measure from. So the next thing I'm going to do is I'm going to get the Fibonacci retracement lines. I'm going to start at the low right there, right around 119 or 113.90.95 level, and then we're going to map it right to the 119.19 high. And just keep in mind the Fibonacci's it's not a line in the sand. This is basically, I would say, a zone. Basically, you're not looking for an exact level. You can kind of look roughly, plus or minus 5 to 10 points as a zone. I typically don't use the 23.6 or the 76.4 Fibonacci's. They're not very widely used when it comes to using the retracement levels. So I'm going to go in here. I'm going to take them out, the 23.6 and the 76.4, just to make the chart a little bit cleaner. So right now what we have is we have the 119.19 high roughly, and then the 113.90 low. And then the first Fibonacci, which is the significant level we're going to be watching first, comes in around the 117. I think the actual level came in at 117.18. So what we're going to be doing is we're going to be watching to see how price responds, or if we can get down to these levels. And then usually it's the first reaction off of the test of these levels where you see the biggest response. So what I'm going to do is I'm going to show you, I'm going to change the date, add the next 2 days after that, which brings us to the 19th, 19. Right, and there we go. We, as everyone knows, we got a nice little pullback. This bar here on the 19th came down to a low of 117.28. If we're going to go another day, basically, let's add one more in there. Actually, we're going to add two because that was the weekend. So there you can see on the same bar that we made that low of 26, which is well within what I consider to be the Fibonacci zone, we had a nice bounce to 118.0. It actually went up to 118.04 on that day. And then if we add another day in there, we're going to go to the 25th. I added an extra day in there, but what we did was the full move on that first bounce was up to 118.20. So you actually had a nice move, a 94-point bounce off of the first test of that retracement. So then what happened afterwards is it pulled back, it went through that level, and then it went down to the 50% retracement, which came in at 116.53 roughly. We actually made a low of 116.45 that day, but then we had a very nice bounce back up to 117.80, which would be the let's get this in here. We're looking at October 1st. And if you look at that, that was a really nice bounce off of the 50% Fibonacci all the way up to 117.79, which was 126 points. So by doing just the simple work, takes a couple of minutes, you can map out these retracement levels, and I would look at the first response that you get off of these levels is usually the strongest response. And in this case, just doing a little bit of homework, couple of minutes, 220 points delivered from using the Fibonacci retracement levels. Definitely worth keeping an eye on. So that's a simple example of how the Fibonacci's can give you structure and high quality trade locations, and it only takes a couple of minutes of your time. It's the same process I've used for over 30 years, and it works.